Moving on to the last section of our presentation, the way forward. I hope you are able to see my mouse also. This is how our current scenario looks like. Our current components, our salary structures include components which are explicitly included. There are also components which are explicitly excluded, and there are many components which don't find any mention in the definition of wages, and then there are some reimbursements. In the new world, the components which are not mentioned, like special allowance, become a part of qualifying wage. So we need to move away from this kind of a structure to a structure where the components, that are explicitly included are more, the components which are explicitly excluded that are more, and the components which don't find them mentioned, we should consciously choose to place them in the that portion in components which do find a mention. Basically, you have to design your compensation structure largely between explicitly included and explicitly excluded components to avoid any gray areas. You will have to modify these policies also to manage the impact on earned leave liabilities. And when we do that, we will have to check compliances of Shops and Establishments Act and the OSH code. We do have to ensure that bonuses are not part of employment contract, and to do so, we have to make sure that they're not paid monthly, they're not universally payable, and they don't have direct linkage to the increased output. Overall, as I mentioned earlier, this is essentially an iterative activity where you consider various compensation structures from the point of view of balancing take-home pay versus increase in ongoing costs versus the one-off hit that comes into your P&L versus the tax benefits. There's no one compensation structure that can solve all the things, and somewhere you will have to consider various and see what best fits your organization. If you are a young organization, you may not have a lot of past liabilities. You probably can structure it differently compared to an organization which has existed for say 20 years, and change in compensation structures in certain ways could mean a much higher impact on their balance sheet because of the past service cost of restatement of the liability. I'd like to end this slide by just saying that as we look to move from current scenario to target scenario, we must keep a sense of proportionality in redesigning. Some of the companies have approached saying that why can't we make HRA 40% of the total CTC, and conveyance 20% of the total CTC. I believe there has to be a sense of logic and proportionality in redesigning. What may seem like an optimization today may become a litigation tomorrow. So please be very careful and mindful in how you go about restructuring this. Please do remember that when the government came out with this definition of wages, it did so with the intent of increasing the social security components, and we should keep that in mind. Of course, we should optimize to whatever extent we possibly can and mitigate the impacts. But we should remember in mind that the sense of balance and proportionality in doing this restructuring. Overall, the way forward, I guess we've covered it as a part of our talk already. Do not guess the impact, measure it, right? The new wage definition and the other definition changes that we have spoken about in this presentation have direct balance sheet and P&L consequences. These changes will have an impact on your budgets, your annual operating plans. So restructuring of compensation under the codes is not this mechanical. You have to consider various scenarios, various approaches, and the answers will be very different for, say, an industry which has a lot of workers versus a company which has which only say a consulting firm. It will also vary between a young organization which may not have too much of a past service impact versus an old organization which may be hit materially. Gratuity and leave liabilities will change. obviously the quantum, as I just mentioned, varies by structure, tenure, and workforce mix. And overall, we believe that implementing the whole labor laws is a big activity. But even the aspects that we have discussed here requires coordination between HR, finance, legal advisors, and actuaries, and would strongly urge you to run it as a cross-functional activity to make sure that you optimize as you go for compliance, you optimize your compensation structures in the best possible way. That's pretty much it from our side. The idea here was to give you an overview of what is hitting us as as we move into just a second. As we move into the next next few days, the codes are live. We don't have an option to not implement them. Some of the companies have asked us whether we need to comply in our valuations in December. Well, the answer to that also, in our view, is yes. You can't take the pretext that your rules are not out there. It has been clarified that till the time the rules are out there, the existing rules will continue to apply. That's it from our side in terms of the presentation. I hope you found the content useful, and some of the questions that you may have had get answered. We'll now open the floor to questions, and we'll now request some of the questions that are coming up, and we'll try to pick up the questions which are the most frequent there. So Arzu, can I request you to share the questions, please, so we can answer?
Sure. Thank you so much, Khushwant and Surbhi. It was a very informative webinar. Hopefully, many of the doubts are cleared now. So we have more than 100 questions, and answering all of them would not be possible. Most of them are repetitive also. So I'll pick up a few, and then we can share the FAQs with all the attendees separately in a 1 or 2 days time. Okay, so one question that we have here is, how do we separate the impact of the new wage definition from regular annual salary increases in valuation?
No, so if you look at the standards require past service costs to be calculated as on the date of implementation. Now, assuming the date of implementation is 21st November, which is the legal position, then any restructuring that happens as on that date, which does not result in an increase in CTC, all of it goes into P&L as past service cost. At the end of the year, now say the CTC has gone up by 10%, right? So then we do have some data point to say that this is a general increase, and the rest of it can be attributed to the code, because at the end of the year there are general increases also. But whatever changes happen as on the date of implementation, all of that is past service cost and gets charged to income statement.
Thanks, Khushwant. Okay, one more question that we have here is, will the financial impact be immediate, or will it build up gradually over time?
My understanding is that it will be immediate. There is nothing that allows us to defer. The law has been implemented. You will be paying out higher gratuities immediately. You will be settling leave liabilities for workers on a higher basis immediately. So to that extent, the hit is immediate. Of course, in US GAAP, there are certain rules that allow you to recognize past service over a period of time, but that's separate. Keeping that aside, the legal compliance requirements are immediate, and and consequent hit that will come because of the valuations are immediate. Of course, ongoing cost will also go up, and that will show in year-on-year P&Ls.
Okay, thank you, Khushwant. Now, this question I think you have already answered, but it is very repetitive, so I am just reading out loud. Will variable pay or performance bonuses now be treated as part of wages for gratuity calculation?
No, there will not be. I know this question is coming again and again. To me, till the time the bonuses are not committed, they're really variable and paid at the end of the year, linked to the performance of the employee and the performance of the organization. They're really not wages and will not be included. Some of the landmark cases, I mean, this position has been discussed, debated, multiple times in the Indian legal system, and there are multiple case laws that exist on this. Especially the Vidya Mandir case that is there, it establishes principles, and I don't think those principles will not apply under the new laws. They will continue to apply. So we can safely assume then variable bonuses, variable non-statutory bonuses, which are not committed to be paid at the start of the year, will continue to be safely excluded. Documentation around this will be important. So organizations need to be mindful of that.
Great. Now, one interesting question here. Is it advisable to run parallel gratuity valuations under the old and new wage definitions during the transition period? And for that matter, leave valuations also?
So do you want to take that, or should I go ahead?
Yeah, you can go ahead, Khushwant.
See, again, the requirement of the standard is that on the date of change, there is past service costs. So you have to restate on that date and then move on from your service cost from the change date of new change will be based on the new basis. So the standard does require you to do that. I understand the organizations, for practical reasons, are still restructuring, determining their strategy. I would like to reiterate, organizations, law does not require you to restructure. The law only says that you pay on these wages, right? Restructuring is to balance our own needs. So you still have time to restructure, but whatever, till the time you're not restructured to whatever you believe is optimum, you will have to continue to pay gratuity on the qualifying wage, which will be more than 50, 60, or even 70% under your current compensation structures.
Okay. I'll take one more question here. So if there is a component like special allowance or other taxable allowance, which is not in exclusions, that itself would be counted as wages as per the new definition?
Yes, because it's a guaranteed component. Anything that's not excluded will get counted as wages.
Okay. Khushwant, also, can you throw some light on PF? There are a lot of questions on PF. One question here is, for PF, still we can deduct 1,800, which is essentially 12% of 15,000.
See, okay, I'll start with a disclaimer before I give my opinion here. We are not labor law consultants. We would want you to be sure with your labor law consultant of what you're doing. But what I practically believe is that there are 2-3 things that we need to keep in mind. One, the codes prohibit you from reducing the benefits from employees or the social security contributions. So supposedly you are paying, the minimum is 15,000 and your basic was 40,000. And now under the restructured qualifying wages become 60,000. In my view, you can still continue to pay PF on 40,000 because it's above 15,000. You need not go to qualifying wage. That's one of the approach many of the entities are taking, and I believe it's legally tenable. You're not reducing it. You're above the basic bare minimum, and you don't need to go to qualifying wage. That said, I know many companies who are saying that either it's minimum or it's qualifying wage, and you can't reduce, so you have to move to qualifying wage. If you do that, there is a hit. The contribution goes up, take home pays go down. If you're taking that way, approach, then you will have those hits, and you will have to see how you mitigate those from employees' perspective. But the first view also, I'm hearing many of the organizations are taking, and interestingly, I've heard different views from different legal advisors. But I do believe you can continue if it's above the bare minimum to pay on basic, subject to you not reducing your social security contributions.
Thank you, Khushwant. Okay, so the last question here is, since basic salary already accounts for 50% of gross, please advise whether any salary restructuring is required under the new wage code.
2-3 things. One is the restructuring is not required or mandatory. You can continue with your existing salary structures. It's just that what will be qualifying wage for gratuity, for leave for workers, that will be as per the new definition, and it's only advisable for you to consider whether there is scope for you to optimize. And the need for you to optimize will be more if you are an old organization, this will be a young organization where we are really where you really may not have a large impact. So there is nothing that's mandatory. It's optional, of course, but it's probably important for you to consider and see if there's a scope for optimization.
Okay. Great. I think
Okay,
that will.
what I'll do is, Aju, I think we have answered quite a few of the questions, but there's still a few. Let me just run through,
Sure.
for 2 minutes, some of the questions and try and answer those. Will variable pay or performance bonuses be treated as part of wages or for gratuity calculation? We have answered that. No, subject to the points we mentioned. Will variable performance incentives given annually be a part of wages? Again, no, subject to the points we mentioned. Do the leaves or overtime rules become applicable to full-time employees as well? Full-time employees who are workers, yes, they do become, and the definition of worker is not applicable only to blue-collar employees, but also to white-collared. You're advised to go through the OSH rules, and the category, who is a worker is not based on designation or salary, but actually based on what the person does. So even a company, even a consulting firm can have a lot of workers sitting there. So be mindful of the definition and get your compliances right. Okay. We pay our fixed performance pay if they reach the minimum sales criteria for a particular month. Does this also get included in the new definition of wages? My belief is that there's a clear nexus between payments and organizational performance, so you can exclude that. Please clarify whether reimbursements, fuel, driver salary, communication allowance, meal vouchers will be excluded. Pure reimbursements can get excluded, but there is a bit of gray here. We'll come back to you separately on this answer. Someone has asked, that means gratuity is payable only up to 50% of gross salary. No, 50% is the bare minimum. It can go to 60, 70% also in some of the cases where they're not restructured as of now. We are seeing, very commonly the qualifying wage to become 65 to 70% of the overall wages, of the overall CTC. Repeated question. So if there is a component like special allowance or other taxable allowance which is not in inclusions, that itself would be counted as wages as per the new definition. Absolutely. Do I need to make basic component as 50% of salary? No. I again restate, there is nothing that in the law that tells you to restate and how to restate. To restate or to restructure is only a choice, and the choice that should be driven based on your own, your own mathematics. That will vary for each organization. It will be different for young. It will be different for old. It will be different for the mix of the employees between workers and this thing. So, nothing is mandatory. It's, only the qualifying wage definition is given. If you don't restructure it, you just move to the new definition, pay higher gratuity, higher leave, and you're fine. If you want to optimize it, then you get down to restructuring. And in restructuring also, the choice is not, they don't tell you what to do. You just, have to consider your options based on your peculiar circumstances. Someone has given us some base, questions, including some numbers. I'm skipping that. We'll come back to you. It becomes very difficult to answer based on numbers live. What about, for listed companies, do they have to provide in the upcoming December quarter? My answer to that is yes. We do have to provide that right now. The law is applicable and we don't have a window. Another question is the new wage definition applicable immediately or only after 1st April 2026? The same question, in my opinion, it's applicable immediately. In fact, this was clarified in response to one of the questions asked in the Parliament also. And I think there was one webinar that was conducted by NASSCOM earlier today. They will be posting, it was conducted by Trice Legal. And they also suggested that it's live today, but they'll be posting their webinar, I guess, also on their website, so you can go through that. Of course, consult your labor law consultants before you take a final opinion. But in our view, we are live today. That's pretty much it from our side, everyone. All I would say is these are big changes in introduction of labor codes, and the biggest of all is the new definition of wages. The government is looking to strengthen the social security landscape for the country. And that is why you see the changes in the definition of wages that you see. Of course, the government is also looking to not just do that for everyone, but especially for workers. This does mean that you have to restructure or rethink your compensation strategy and do a thorough budgeting exercise. I hope you found this whole talk interesting. I hope we could answer some of your queries. We thank you so much for joining this webinar, and we look forward to staying in touch. Thank you so much.
Thank you so much. Thank you.